Can you?
Or maybe to use this one.
Okay, this looks more like a rock star. It's great to have Estelle Cantillon here with us. Thank you so much for being here in Madrid at the Symposium of Analysis Económico. I think most of you know Estelle. Estelle is a research professor at the Université Libre de Bruxelles, and she's also affiliated researcher at the Toulouse School of Economics. She's been working on the boundary between market design, industrial organization, and more recently working a lot on environmental economics. Her work combines both theory work and empirical analysis, and she's published work on auctions, procurement, competition between exchanges, and assignment problems. She's currently working as a managing editor of the Economic Journal and associate editor of the Rand Journal of Economics. Today she's going to talk to us about emissions markets, what they can achieve in theory and practice, and we look very much forward to listening to your presentation. Thank you very much, Estelle.
Thank you. It's really a pleasure to be here. Thank you for hanging out until the very end of the conference. So I'm going to talk about, it's a little bit of an ambitious title that I gave when I accepted this talk. Emissions markets, what can they achieve in theory and in practice? And of course, I was expecting to be able to do more by the time of December than what I've achieved. But I hope to be able to give a little bit of a wrap-up of where we stand here. So, really big picture. I'm sure you've heard about climate change. This is a graph that shows the annual carbon emissions by different area of the world between the 18th century until today. The yellow part is Europe. So you see that this is we're a significant part, but our share of total greenhouse gases emissions has been declining. The United States, those that are really growing fast are China, India, and so on. Carbon emissions are connected to the greenhouse effect, which keeps the heat of the sun on the planet, and so connected to climate change. So the emissions markets have been used as one of the leading policy instruments to tackle, to try and induce a reduction in emissions. The first time emissions markets for carbon were discussed were the Kyoto Protocol. There was the United States pushing for it as a way to reduce the cost of reducing carbon emissions. So the Kyoto Protocol is 1997. Nowadays, the carbon markets in Europe is still the largest market, carbon market in the world, but China has one, South Korea, California, there's many other jurisdictions that now have carbon markets. There's always this discussion between whether we should have a carbon tax or emissions markets. The goal here being that we need to put a price on carbon. Carbon creates this externality. So there's a big debate starting from Weizmann 73, I think. Industries, companies tend to prefer emissions markets. And it's a little bit of, sometimes for me, a puzzle, because at the same time they also are interested in having a very stable, clear signal, a price signal to know whether they need to invest or not. And emissions markets are actually much more volatile because you're fixing quantities, you're not fixing a price like carbon. So one of the reasons I can see for carbon markets being favored by industry is that typically they're a little bit more flexible in the sense that, yes, you'll get a price signal given by the price of allowances, but governments can give out for free many allowances, and that's a way to reduce the burden for industries, for companies involved in these markets. And you can also see that if you look around and see existing carbon markets, the price of allowances, the price of carbon that have been generated by these markets have been much lower than what is considered to be the true social cost of carbon. So in some ways, would be another reason why companies may prefer this. The other instruments, carbon taxes, I've mentioned those already, subsidies for example, energy efficiency or other types of investments that reduce carbon, standards, pollution standards, or like standards for cars and so on and so forth. Okay, I want to give Economics 101 on emissions markets briefly, and then before moving to the answers and to my research. So the setting here, think about firms that are producing some pollutant. This pollutant is produced as a byproduct of an otherwise very socially valuable activity. They're producing products. It just happens that they're also producing emissions at the same time. And we're going to call E sub I as the emissions level business as usual. If nothing happens, if they're just using their current production process, here's the emissions that they would be producing. But they can actually produce the same products with lower emissions, maybe by re-optimizing outputs or by investing in some energy efficiency or changing fuels and so on. And so this would be captured in this abatement technology cost curve. It's so cost of as a function of the abatement level. So abatement means you're reducing emissions, and theta would be a characteristics of the firm. Different firms would have access to different abatement technologies. So if the objective for the government is not to go beyond the target of emissions given by N, so this is a vertical line here, what you do, so you just, this is N, you are mapping here the aggregate marginal abatement curve. So at the level of business as usual, this is equal to 0, and this is just going up. You have a convex curve. The more you need to abate, the highest it costs. And so you can see that from this graph, it's easy to see which firms need to be doing the abatement effort. It's those with the marginal abatement cost lower than the intersection here. Okay, so that's basically the question that a market is doing. So this is if you knew exactly the marginal abatement cost of all of these firms, you could actually figure out easily who should be doing the abatement effort. In practice, we don't know this, and so that's why markets are useful. So what you do is create a property right. It's the right to emit carbon. It's an allowance. And firms we're going to measure how much carbon they emit, and firms would need to cover up, surrender as many allowances as they have emitted carbon. So now what is, and this is really what I'm presenting here, is really the baby toy canonical model of such markets. You can be more sophisticated, but essentially what firms are doing is that they're going to minimize their compliance cost, which is the sum of, so they're choosing AI, so the level of abatement, YI is the number of allowances they're going to buy, and their cost is P, the price of allowances, times the number of allowances they buy, plus their abatement cost. So then that's their total compliance cost. They're minimizing this subject to the constraints that the number of allowances they bought plus the amount of abatement that it needs to be at least greater or equal than the level of emissions in the business as usual setup. Okay, and so you already know what the answer is. What do you do is you're going to equate marginal cost of abatement with price, and so this is actually what's going to give you the solution, the optimal allocation of abatement through a market. Okay. Now this is a very simple way of presenting an emissions markets. In practice, if you look around at carbon markets or emissions markets more generally in the world, you'll see there's a great variety of designs. So there are many design decisions actually. For example, how many allowances do we put in the system? How do you allocate them? Should you give them freely to the firms? And if so, how? Should you auction them? What is the length of the compliance period? Should we have every year? We should make sure that the firms surrender as many allowances as they have emitted. whether these allowances, are they valid just for 1 year, or can they be banked, meaning that if you don't use them today, you can actually use them tomorrow and in the future? Can you borrow when you know that you're going to get allowances in the future? Can you use them today? So these are all kind of important design decisions that have to be taken. And in some ways, what I'm trying to argue here is that maybe there's a lot of interesting economic question that maybe we've not all, there's still a lot of things we need to know more about this. What's interesting is that, I've just listed the long list of design decisions, but I've been following this market for a long time. So at the very beginning in Europe, it was created in 2005, and there's a quote from a publication from the European Commission, 2004, that basically shows that from the European Commission's perspective, this is actually very easy to create a market. You just have to create property rights. So this is a quote that says, "The legal framework of the ETS, so emission trading schemes, does not lay down how and where trading in allowances should take place. Companies and other participants in the market may trade directly with each other or buy and sell via broker, exchange, or any other type of market intermediary that may spring up to take advantage of a new market of significant size. The price of allowances will be determined by supply's demand as in any other market." In some ways, it's, my emissions market 101 is this, but this is not what happens in reality, okay? And the European Commission has learned the hard way that design matters. So this is a very short history of how it works in Europe. It was created in 2005, the first phase. It's a pre-Kyoto phase because, again, these markets were created through the Kyoto Protocol. The first phase was 2008, 2012. That's the Kyoto phase. Europe started with emissions markets before. So, that working? Yes. Okay. So, and what you see here, I'm not going to spend too much time because I think I need also to make sure I have time for everything. But what you see is that at the very first phase was very hands-off. Okay, so there were some guidelines at the European Commission level, but they left the member states to take a lot of decisions, including how many allowances to allocate, how to allocate them, whether these allowances were going to be treated in the legal, in the national law as an asset or as a commodity, meaning having implication for VAT. Some countries had VAT on allowances, some others didn't, and so on and so forth. Most of these allowances in the beginning were grandfathered, so it means we look at historical emissions by these plants and we basically give allowances more or less under that proportion. Phase 1 was a little bit special because there were the allowances of phase 1 would not be, you could not use them in the later phases. So one of the things that changed with the Kyoto is that your allowances now can actually be used, the phase 2 allowances can be used in phase 3 and phase 4. These are markets, by the way, that you have to negotiate the rules 5-10 years before, and then they're fixed for a number of years during the phase. Okay. So what happened? Phase 1, played out. They already had started negotiating phase 2, and in phase 2, the market almost collapsed. Okay, three things happened. The first thing is that there were hacking events. Some of the registries, which are the places that record who owns allowances, they were at the national level. Some of them were hacked, and so some of the allowances were stolen. First thing. The second thing is that there was a VAT carousel. So I've told you that in some countries, allowances were subject to VAT and not in others. Well, what happened is that you had people buying allowances in a non-VAT country and selling them in VAT countries. And Euronext collapsed on this. The French government, I think, lost billions of euros on this. Okay. The third thing is that it's also the economic crisis happened. And so there was the number of allowances had been fixed, and so suddenly the whole industries and the whole power sector also, reduce its needs, and so there were just too many allowances in the market. The prices went down to of the order of 2 or 3 euros at some point. And in the meantime, so what happened going forward, again in summary, what happened is that you started to have greater centralization or at least harmonization of rules. Now these markets are regulated as a financial market, so MiFID applies. There's no VAT across the board, okay, this is across countries. And dealing with this economic, the glut in allowances, I think something is wrong with my ear. It doesn't hold the microphone very well. And so the other thing that happened is that there's built in now, it's actually, it's been agreed for phase 4, so it's 2021, 2030, but it's going to be introduced already in 2019, January. It's called the Market Stability Reserve that's going to somehow, instead of having the number of allowances fixed ex ante 10 years in advance, now we're going to have a mechanism that regulate the number of allowances in the system according to needs. So just to avoid the fact that there's an economic crisis, suddenly, firms don't need allowances so much, what do we do? Okay, so that's a quick way. So this is actually what you see now. If you look at the evolution of market emissions in the EU, the allowance, the emission trading schemes covers about 50%. Now it's or even closer now to 45% of emissions, and it's been decreasing. So that's the blue lines are the EU ETS emission trading scheme sectors, so electricity generation, cement, ceramics, and so on. And the other sectors not included in the EU ETS are residential and heating, transportation, agriculture, for example. Okay, so now I want to start with, what do we know from theory from this? So this is the same graph as I showed you before. So the foundations for having emissions market is just the first welfare theorem, right? You have competitive markets. It's going to deliver the efficient solutions, and specifically, it's going to minimize the cost of compliance. Okay. Now, of course, what's more interesting? So it's a static framework. You want to add time. That's what I want to do. So what happens when you add time? Several things. The first thing is that now, as a firm, I have the choice between whether I want to abate today or abate tomorrow. So there's going to be intertemporal optimization that I can do. Okay, and there are also several papers that, in some ways, there's still just application of the first welfare theorem, but to that dynamic setting, where you can show that it's emissions market are going to lead to the minimization of discounted costs of compliance. The second thing that happens when you add time is that there's going to be uncertainty, because clearly today you don't know what's going to happen 3 years from now in terms of emissions. So in terms of when you do this optimization, you worry about this uncertainty. And so there's one of the questions that you need to address is, maybe it's good somehow at some point, especially if you can't borrow future allowances, is to buy a little bit of extra of allowances and store them. And so there's you can optimize also on this and figuring out what's the optimal amount of allowances you want to store to deal with potential shocks going forward. What's important is that existing literature has not, it deals with uncertainty, but it's not dealing with private information. So the uncertainty is exogenous, but everybody is symmetrically informed that there might be some shocks going forward. I think what's important, and that's what I've been working on, is trying to add private information to the system. Okay, now because when you add time, what happens is that at every time you need to figure out your decision today is going also to depend on what you expect the future to be. Okay, and then the future balance of supply and demand, and that's going to depend on your own abatement cost, your own emissions, and all of this. There's no reason to think that they're complete information about this. If anything, there's actually a lot of asymmetric information about this. So I've worked. So the first thing, this an area that has interested me for a long time, but we just produced our first paper here. It's finished. It's called Information Aggregation in Emissions Markets with Abatement. It's with Aurélie Slechtens, who's at Lancaster university. And so what we do is we extend the canonical model that I've just shown you, but I'm going to allow for private information about abatement and emissions. I'm also going to model explicitly the sequential arrival of this information. So I'm just trying to, and in here, the way I'm going to think about this is that now we're in December. As a firm, I know very well how much I've emitted this past year. But I have some signal, but it's this noisy signal about how much I'm going to emit in the coming year, 2019. Okay. In December 2019, clearly I will have more information about my emissions. Okay, so there's sequential information for me. You know, I'm getting more information about my own emissions. Plus, there's also this thing in the European emission trading scheme. There's also this thing that the European Commission releases information about realized emissions in April of every year. So now private information becomes public at every year around April. Okay, so there's private information, sequential, and this public information. So what we're now doing is that we have these three little extensions of the canonical model, and the question we ask is, can emissions markets fully aggregate information in that setup? And what I mean by full information aggregation is the sense of the same meaning of Grossman 1978. It means that can the prices be a sufficient statistic for all of the private information in the economy? Okay. It's a classic question in finance. It's never been asked in the environmental economics literature, and I will argue that, and there's actually huge literature in finance too. What's going to differ in emissions markets relative to a standard finance setting is that it's abatement. Abatement is different, right? In a finance setting, you have assets. There might be signals about these things, and you're learning something, but you have nothing close to abatement. Abatement means that you're eating your assets in some ways, endogenously, because it's going to be endogenous. Depending on the price, the realization of price, you're going to abate more or less. Okay, that's going to make mathematically the problem a little bit different. And we're going, except for these little extensions, we're going to do exactly the same as in the canonical model. And in particular, we are going to give the market its best chances by assuming an equilibrium concept that's the rational expectations equilibrium concept. It's not a great concept, but it's the one that's giving the market the best chance. If I cannot make the market work, even assuming rational expectations, then anything more realistic will be problematic. Okay. So what are the? This is actually a little graph of the timing. I have a little bit of time. So there's a finite number of periods. These are the actions that people take every beginning. So every beginning of every period. Think about January. You're deciding how much you want to abate. At every time new information hits the market, so that it's in January and then in April when the European Commission releases information about abatement, there's an opportunity to trade. And in terms of information, so you've got private information is at the beginning of January, you know how much you've emitted the previous period, and you get a noisy signal about this current period. So it's X is the noisy signal, and E is your past emissions, and there's public information being released. So that's in April, you get the public information about past year emissions. Okay. So what are the results? I'm not going to show you all the developments and the math here. I just want to get to the bottom line. So what you see is that when there is only private information, about emissions, okay, so which means that if the cost of abatement curves are are complete information, then you can show that there exists a rational expectations equilibrium that fully aggregates private information. Okay, what this means, so this is actually good news. So it means that the market can play its role, and that the rational expectations equilibrium is going to minimize. Now, instead of having the discounted cost of compliance, I have the expected cost of compliance at all times. Conditional, of course, on the information that's available in the economy, but it's doing the aggregation. What this means in particular is going to be important when I turn to the empirics, is that It means that when the European Commission releases information, people should not react to it. It's been aggregated already. Okay, we don't need that mechanism. Now, if there's private information both about the emissions but also about the cost of abatement, then the whole result collapses. Okay, and at this stage, we just have an impossibility result. You can't, the prices cannot play a sufficient statistic role anymore, because you can't tell whether, when you see prices, whether it's because of a high or low level of emissions, or it's a high or low cost of abatement. Okay, so that these are the results. So what are the open questions? So we just completed the paper, but clearly it raises even more questions than it answers them. The first thing we'd like to know is now what happens. So we just have an impossibility results about aggregation. What happens actually when there's also asymmetric information about abatement costs? What can we hope that the market achieves? How will information get into the market? So it's the first question. There's also a question about the role of design in supporting information aggregation. So what kind of information feedback should we put in place, given that we know that this is the way, this is the structure of information? What can we put in place to help the market figure out the relevant information? And we've derived these results, less important, but we've realized we have derived the results in the framework of a finite horizon market, which is the first phase of the EU ETS. How does that generalize to infinite horizon markets questions? Okay. So I'm going to turn to the empirical, to the data now, and just see and see what happens here. Okay. So first thing I want to show you is show you just price series. So the first one, this is the evolution of price during the first phase of the European carbon market. So it's 2005 to 2007. And what you see first of all, you see that the prices collapse at the very end. This is completely compatible with equilibrium behavior, because what happens is that these allowances lose entirely their value at the end of the phase. So, of course, if you figured out that there are more allowances in the market than the demand, then at some point the price is going to converge to zero. Okay. There are other interesting patterns. I mean, it's very volatile. It's at the very beginning. There's a lot of uncertainty. There are two things, two events I'd like to comment a little bit more. The first one is there is a bubble in July 2005. It's a really short bubble, but the prices go up, quite a bit, because it starts from 18 euros per ton to almost 30 euros per ton in a very short amount of time. So the question, what happens? Now, if you go to the industry literature, there's a bunch of reasons that are given for this phenomenon. The first are things that you and I would put in the model, and they would be accounted for the model, and they're fine. So the first reason is that at the beginning of 2005, there were several national allocation plans that were not been approved by the European Commission, and they were approved with cuts. So, some countries submitted plans to allocate allowances to their industries, and the European Commission said, need to, be a bit stricter. Okay? So clearly what this means is that less allowances in the market. So that's obvious that this should be pushing the prices up. It's a summer also where the price of gas was very high. Why does it matter? Because gas is used to produce electricity, but if the price of gas is high, it means that producing electricity with coal is more cheaper, it's better, and coal produces more carbon, so this should be increasing the demand for allowances, so this is totally fine. It was also dry and hot summer, so meaning more higher electricity demand for air conditioning and so on. But what's interesting is another argument is that the long firms, so the firms with too many allowances, are not in the market. And when the bubble burst, the same industry observers basically said, the reason now the price went down is because these guys have now they're expected to be coming soon. Okay, so remember this when I'll show you a bit more things later on. But so these are one thing that happens. Second event, it's a huge collapse in the carbon emissions price in April 2006. That's when the European Commission releases information about the realized allowances. So it's when private information becomes public information. Okay, and what you see here is that in this particular case, there were several countries that actually had emitted less than we were expecting, and so the price is just reflecting a correction in expectations. But clearly, this should not have happened if prices were fully aggregating private information. Okay. Now I'm going to move to phase 2 and phase 3, so that's today. So and you see that there's still a lot of variation. The scale here is, it started around 30 in 2008. It's gone down at some point, it was around 2 or 3 euros per ton. Now we're closer to 20. It's still very low compared to what is considered to be the social cost of carbon, by the way. Okay, but at least it's going up again, but probably, and we know, most probably because of the mechanisms that have been put in place, the market stability reserve to decrease the amount of allowances in the market. Okay, so there are essentially two issues in these markets. One is more of a political issue, I would argue, is the fact that if you want to have a price, I mean, at some point you need to figure out what's the balance of. It's a balance between supply and demand. Okay, if you put too many allowances in the market, clearly the prices are going to be low. How many allowances you emit you decide is to some extent a political decision. And so I'm not going to spend too much time on this. There are too many allowances in the market. That's true. Okay. Now the question I'm interested in is more the question of, once now I have fixed the number of allowances, how can these markets be able to efficiently aggregate the information? And therefore, because that's why their design is to what extent can they generate the investment signal that firms need to figure out whether they should be investing in reducing emissions. So I'm going to go through 3 aspects. One is participation, the other one is market fragmentation and risk management constraint. I'm going to give you evidence based on the data. So it's the kind of data you have about these emissions is the following. So the European Commission now has all of the registries for who owns allowances is at the European Commission level. After a period of 3 years, so it's actually very nice. For a period of 3 years, these data become public, including the transactions. So I know whether and Natalia and I traded. There's going to be sometimes written like Natalia sold, 1,000 allowances to Estelle on December 13. That's going to be public. It's not the price is not present, okay, but at least I know the transaction. I also know how many allowances Natalia had to surrender to cover her emissions. So there's a lot of data that are available, and it used to be only with a becoming public after a 5-year window. Now it's 3 years. The only challenge for researchers is that these are data that are at what is called at the installation level. So it's not a firm, or it's not even a group of firms. It's really at the unit that produces the emission. So you need to clean it a little bit, aggregate it to figure out the proper level of decision. But these are the kind of data that are available. It happens that. Given that I've only started producing research, but I've been long interested in these data in this market, and so I happen to have had a research assistant many years ago asking data from these exchanges at the very beginning when they were set up, and so I actually have tick data from some of the exchanges that nowadays you wouldn't be able to get anymore. But at least that I can match this with the transaction data. Okay, so the first thing I want to show you is to talk about partial participation. Okay, what is this? So you have a market. Those who have to be part of the market are these regulated firms, okay, because they have to surrender allowances to cover their emissions. Then anybody else, you and I, can actually be part of the market, okay? it's open. But the ones I'm going to focus on is on the firms that have no choices. They're going to be, I'm calling them operators. The operators here are already an aggregation of, if I have, a firm, I'm going to have all of the installation units of that firm already aggregated. Okay, I have about 6,000 of these operators. And what you see here is the cumulative distribution function of who has access to the market. What does that mean? It means that I have access to a market when I can trade. It means I have a bank account, it's called here registry, that shows that indeed I have these property rights. As long as I don't have those, I can't trade, right? Because nothing proves that I have these property rights. Okay, so these are, and it turns out this is the beginning, this is the market, the directive, the European directive to create that market was from 2003. The market was created January 2005, so you can imagine that there was a lot of rush because you have a directive in July 2003. It has to be translated into national legislation, and then you have to set up all of the infrastructure. Many countries didn't make it. And so what you see is that the blue lines is a fraction of those who should be in the market that actually have access in the market. They have an account in the registry. It's about at the beginning, so this is by the end of the first year here, you still have about 70% of the firms who should be in the market have access to the market. Okay, it's the blue line on top. By the end of of course, of the phase, everybody has access to the market. The more interesting curve here is the dotted red line, and it shows you among the fraction of all these firms who is actually active, the fraction of them that are actually active, meaning they're trading on the market. And you see that the proportion is much lower. So even though at the end of the first compliance period, so it's by end of March, they have to surrender the allowances for the previous year, 80% of the firms had an account. Only 25% of them had been active in this market. The other ones, they had received allowances, they were just sitting on their allowances and gave out some of the allowances. Okay, because to some extent they had access to 2 years of allowances at that time. Okay, so that's a first salient feature. Now I want to connect this, the fact that not everybody participated, to the bubble. And so what I'm going to show you is I'm going to reconstruct the average accumulated surplus, I'm going to define what it is, of the firms connected to the market and those firms participating in the market. So these are two graphs. The y-axis is exactly the same scale on the left and on the right, so you can really compare the two things. They have the same scale. And what you see is that I'm going to compute for every firm their average accumulated surplus. So it means the number of allowances they got until then, minus how many they've actually surrendered because they had emitted, and how many they bought, and minus what they sold. Okay, and so what you see here on the left-hand side, what you see is that if I take the whole market, those who have actually access to the market, the connected firms, you see that from the very beginning there's an average surplus in the market. Most of on average, the firms in the market have more allowances than they should be given out to surrender. Okay. And it's only becoming a little bit negative at the end, and it's just the financial intermediaries here. But now so let's just go to the right-hand side. Here it's interesting because it's very different. So if now I only look at the sample of firms that participate, so the active guys in the market, what you see is that at the very beginning, until July 2005, it's the firms that were short. They didn't have enough allowances to cover their allowances that were on the market. And then suddenly around July 2005, it turns, there's a change in the composition of firms that are active in the market, and on average they are long. They are long. They have too many allowances. Okay, and the timing is interesting because it's July 2005. It's exactly the same timing as when the bubble burst in July 2005. So in some ways, even though in the way you construct model, when you construct the equilibrium, it should not be about who is active in the market. It should be whether the market is long or short. So it should be about the left-hand side. the prices should be reflecting the left-hand side. In practice, the market seems to be reacting more, well, reflecting more what happens in the right-hand side. Okay, so that's the first insight you get from the data. Another thing that happens, so right now I had modeled this market as where you have just a single price. The market was actually very fragmented. You remember the European Commission quote said, we are going to let the market take care of itself, and there might be intermediaries and exchanges that are going to spring up and to take advantage of the new opportunities. That happened indeed. There were many exchanges. And so what I'm representing here in this graph, okay, so it's a little bit, it's a complex, it's a nice graph. It's going to take me a bit of time to explain to this. So there were many exchanges. One of them, the biggest one, was Blue Next. Okay, it took 30% of the market. And there were other exchanges, ECX, EEX, CIXA, GME, and Nord Pool. Okay, so what I'm doing now, I'm going to look at the graph of transactions. Right, in my data, I know who transacts with whom. And so this is going to represent a graph of this transaction. I'm going to represent a graph. And I'm going to look at the closeness of each of these exchanges, or in 2005, 2006, and 2007, the closeness in that graph. So what this means is that the closeness measure is 1 if I can connect with to each one of you with one link. So I have traded with each one of you. Okay, so n-1 is the number of firms and participants in my market, -1, plus the sum of the distances. If I've never traded directly to Nezi, but I traded once with Natalia, and Natalia traded with Nezi, and the distance would be 2. Okay, that's how I'm constructing it. Okay, so the more you go on the right-hand side, the more somehow, the better connected this exchange is relative to the rest of the market. Okay. Now, on the y-axis, I'm representing the percentage of days in which the price on those exchanges were outside of the min-max realized prices on this very liquid exchange, Blue Next. If there was a low of one price, it should be always 0, right? There should be everybody should have been in the band between the min and the max. Okay, and so what you see here is the less connected you are as an exchange, the more often you get out of. There are some exchanges, especially the one in green. So GME, it was a very small exchange. It was most of the days it was just outside out of the min max band of Blue Next. Okay, so that tells you something about you have a very fragmented market. And again, remember, the goal is to get a clear signal to firms, right? So here what you see is the more connected the market is, which means less fragmentation, you would get also closer. And we are far from this in the first phase of the EU ETS. So one last piece of evidence, and I'm going to try and put all of these together, is the question of, and that was a bit of a surprise for us. Okay, so in the carbon market, the way it's constructed today, you are receiving your allowances for a given year in February. You have to surrender your allowances for the previous year in March. So this means that in every single year, you have in your pocket the equivalent of 2 years' worth of allowances. So it's actually one way you can easily borrow. That's what it means. Now, even if you can borrow, so if you imagine I'm emitting a lot today, I can actually borrow from tomorrow's allowances to cover. Firms did not do this. Okay, so you see this both from, we interviewed some of these firms, but you also see some of the hedging data of these electricity companies. They show that they are actually basically hedging everything. This means that if they're emitting a certain amount in a given month, they're going to buy at the same time the allowances to cover what they have emitted, even though they have until March to do this. But they're going to cover their emissions as they accrue. How do they do that? They can buy a spot allowances, real physical allowance, or they can go on the futures market. Who's on the other side of these markets? Financial intermediaries. Okay. Now, it happens that financial intermediaries also have risk management. That's risk management control, and so they also have to cover their emissions. Okay, so their position. So here are two financial intermediaries in our data. One is Fortis, and the other one is Shell Trading International Limited. They were big actors at the time. And what you see here in those graphs is the quantity of allowances that they have in their books. The vertical lines are December. Okay, what happens in December? It's when it's a common maturity for futures market. So when you buy a future in December, that's when actually in December you have to deliver. And so what happens? You have a very triangular. So if people here, there are people in the room who are in finance, they would actually know or know about this risk management. Seems to be a very common pattern where the closer you are from the maturity, the greater the proportion of your position you need to cover with allowances. Okay. So what these two things do together, of course, is that even though by law they could borrow in the market, regulated firms did not borrow because of internal risk management constraint, and those they were buying from, the financial intermediaries, had the same. So there was endogenously a borrowing constraints put into the system, even though by law this was not a constraint. Okay, and so these things can, I just want to refer back to the July 2005 bubble, can explain why, even though firms are going to come into the market, because you need to hedge your position and cover your emissions as they accrue, you will actually experience sometimes prices that are above the long-term equilibrium prices. Okay, which is something you saw. So can design help? Okay, so these are the questions. Here I'm going to be very, it's a bit fluffy because I think there's a lot of, I haven't done the work, but I'm just going to give indications of where I think it does. So I told you that there was a lack of participation when the allowances were given for free or were just given to the firms. So since 2013, so since phase 3, now auctions is a default allocation mechanism, which in practice, there's a lot of exceptions. So in practice, it means about 50 to 60% of allowances are auctioned instead of given to the firms. This means that the firms have to be active in the market. And so, and especially with this risk management constraints, my conjecture is that this really helps the information aggregation in these markets, even though the reason for why we have auctioning in the market is not about making the market work better. The reason why they have auctioning is a question of redistribution, of course. At some point, you want to have firms pay for this. Okay. There's another big reform of the market is this market stability mechanism, which basically says that the number of allowances, it's like a central bank, the number of allowances in the market will depend on on the current circulation of the current excess allowances in the market, and they're going sometimes to put a little bit more or a little bit less in the market. So that avoids the supply and demand imbalances. And again, in the presence of risk management, this will avoid having these big bubbles. Also, so conjectures again here, but so it will be interesting to see what happens here. Okay, and so I'm actually it's a good time, so I'm just able now to finish and with concluding comments. So it's important to remember all the time that these emissions markets are first and most of all political markets. So, in the end, who decides how many allowances and which sector should be doing effort are the politicians and regulators. What we can do as economists, I think, is just thinking a little bit more and forming the design of these markets, especially given that the ultimate goal is to generate a stable, informative price signal, and that hasn't been the case so far. So I think if you combine at least where we stand about the theory and evidence, suggests that there are frictions in these markets. Some of these frictions are unavoidable. There is, information is only, getting into the market. I mean, there's incomplete information at the beginning, and there's risk and uncertainty. Of course, this is going to create volatility. But some of the volatility that we have seen in these markets are actually avoidable through better design, and it's a wide open research area. So I think there's a lot of things to be done here. And then let me finish here. Yeah.
Thanks a lot, first of all. So going back to your theoretical results, so you said that when you have private information only on the emission, you have the price aggregation, but when you have both on the emission and the cost, then you don't. Is this a standard result in this kind of environments where you have private information in two sides, you don't get price aggregation, or there's something peculiar about this market?
So no, it's not a standard result. It's not a standard result. It's really about it's not a standard result because it's because of abatement. Abatement makes the whole difference. So usually, in finance, you would get more information over time, and then you're just updating your beliefs about something. Okay. Now, because of abatement, it's changing. Also, not only your expectation, but also the variance, to make it short, variance of these things, and so it makes the inference a bit more complex. When you have only emission, you still can invert these things, but when you have abatement, it just breaks down. We haven't done the opposite, which is like, imagine if what happens if emissions are known? Can I infer abatement? It's probably true too, but let's see.
One source of volatility is this continuous flow of information.
Yes.
So is this kind of a physical difficulty? I mean, don't we observe more frequently how much pollution is?
So it's a good question. So I think we could actually observe on a more continuous basis. So right now, the compliance is only this verification cycle is only 1 year, but most of the weight. So there are two technologies to verify how much you've emitted. One is it's really measuring, and usually that's a continuous device that measures exactly how much you produce. It's a minority. Most of the most common method, the most common technology is that we look at the amount of fuel you bought, and there are conversion factors. I know how much you. It should be easy to increase the frequency in both cases, and I think that would be useful.
Yeah, so there's one issue which you didn't refer to, maybe it's not important in this case, which is the kind of auction formats, right?
Yes.
So uniform, discriminatory, variations of that. So is this like in all other environments, or is there something special?
No, so I don't think, so I haven't looked into the details of, so I think right now it's a uniform price auction, the way they've set it up at the EX. I haven't looked whether this is, it's just a way of organizing primary. There might be questions also about how this might be affecting the market. But I haven't focused on it. It's true that I should, given that I've done auctions, I should have looked at this. Another open research question.
Thank you. So I wanted to know more about your thoughts about why is the price so much below the social cost. No, it's not. Frictions is one explanation, but I guess there are others.
Yeah. So I think friction is just like it's around the. I mean the basic reason, the basic driver is there's just too many allowances. Firms have, I think they were. The cost of abatement were overestimated, which is typical in many regulation. I mean, the firms always come to the government, and so the regulators say, this is costly, this is costly. I mean, this is just showing it. Yes.
Okay, so I just wanted to ask you whether you have been following the most recent trends on who is participating in this market. I was wondering whether some of these stylized facts that you referred to regarding the fact that firms only buy permits as they have emissions and don't really buy when they expect that the price is going to rise, or the other way around, whether this is still the case, that is, whether as the market evolves and firms are learning how the market is working, they get better at really knowing when to buy and when to sell.
Yeah. So I think there's clearly an evolution. I mean, the reason why I was interested in the first phase of the market is when a market is really illiquid, that's when design matters the most. Because when you have a very liquid market, at some point this is a microstructure. In some ways, becomes second order. So I think that's why I wanted to focus on phase one, because these phenomena are exacerbated. I mean, but the big game changer, I think, has been the auctioning of allowances, and it's a big game changer because what I said, it forces participation, but also most of the activity now these auctions are taking place daily. Okay, so if you think about many other markets where you have a primary market and a secondary market, it could be weekly auctions. Think about government auctions, weekly auctions, or maybe even like monthly auctions. Here it's daily auctions. You have a daily primary market, and so it's been drying up the secondary market, and that that may also have consequences on its own. And again, also an open question to think about.
Okay, so I think we are done. Thank you so much to Estelle for this great and insightful presentation, and thank you all for being here.
Thanks.
Thanks a lot, everybody, for staying late, and thanks again to local organizer for hosting this great event. See you next year in Alicante.